What if oil suddenly hits $150 per barrel? What breaks first, your wallet, the markets, or the entire global economy? Oil is not just another commodity, it is the backbone of the modern economy. Every truck, every flight, every factory, every supply chain depends on it. So when oil prices surge, the impact is immediate. Now imagine oil hitting $150 per barrel. This is not a normal price spike, this is a shock. Experts warn this level could trigger a global recession if it lasts. Reuters. So what changes first? Start with the fastest reaction point, fuel prices. The moment oil rises, petrol and diesel prices follow. Gas stations update prices within days. Transport companies feel the impact instantly. Airlines face higher fuel bills. Logistics costs rise across the board. This is the first visible change. Your daily expenses increase. Now move to the second impact, inflation. Energy is part of everything. When fuel costs rise, production costs rise. Food becomes expensive, electricity costs increase, delivery charges rise, even services become costly. This creates a chain reaction. Higher oil leads to higher inflation across the economy. Studies show sustained oil spikes push inflation sharply upward while slowing growth. Now, focus on households. This is where the pressure becomes real. You spend more on fuel, you spend more on groceries, you spend more on utilities, but your income does not increase at the same pace. Your purchasing power drops. This is the hidden impact. Oil price spikes act like a tax on consumers. Now move to businesses. Businesses face rising input costs. Transport becomes expensive, raw materials cost more, energy bills rise. To survive, companies raise prices. If they cannot raise prices, profits fall. If profits fall, hiring slows. Layoffs begin. This is how an oil shock moves from energy markets to jobs. Now, look at economic growth. When people spend less, businesses earn less. When businesses earn less, they invest less. When investment slows, growth declines. Economists estimate that sustained oil increases reduce GDP growth over time. Now, consider the tipping point. Some analysts say oil above $120 already pressures the economy. At $150 to $200, recession risk rises sharply if prices stay high. Now move to financial markets. Markets react fast to uncertainty. Stock markets fall when costs rise and growth slows. Energy companies may gain in the short term, but most sectors lose. Airlines, retail, manufacturing, technology. Investors move money into safer assets. Volatility increases. Confidence drops. Now focus on central banks. This is where the situation becomes complex. When inflation rises, central banks raise interest rates, but when growth slows, they need to cut rates. Oil at 150 creates both problems at the same time, high inflation and low growth. This is stagflation, one of the hardest economic situations to manage. Now consider the United States. The US is in a better position than many countries. It produces a large amount of its own oil. It is even a net exporter. This provides some protection, but it does not eliminate the impact because oil prices are global. Even US-produced oil sells at global prices, so American consumers still pay more. Now look at a key shift inside the US economy. Income redistribution. Higher oil prices benefit energy companies. They earn more, but households pay more. This shifts money from consumers to producers. This creates political pressure and economic imbalance. Now move to global impact. The world economy is deeply connected. If oil hits 150, the shock spreads everywhere. Transport costs rise globally. Shipping slows. Trade becomes expensive. Supply chains break. Developing countries suffer the most. They depend heavily on imported oil. Currencies weaken. Inflation rises faster. Debt becomes harder to manage. Now look at food. Oil affects agriculture. Fuel powers tractors. Fertilizers depend on energy markets. Transport moves food across countries. When oil rises, food prices rise. This creates pressure on global food supply. Now consider demand destruction. At very high prices, people start cutting consumption. They drive less. They travel less. Companies reduce operations. This slows the economy further. This is how high prices reduce demand over time. Now bring in history. Every major oil shock has triggered economic problems. The 1970s oil crisis caused stagflation. The 2008 oil spike happened before a global financial crisis. Data shows most U.S. recessions were preceded by oil price spikes. This pattern matters. Now look at the timeline of impact. Day 1 to Day 7, fuel prices rise, markets react, news spreads panic. Week 2 to Month 1, inflation rises, transport costs increase, businesses adjust pricing. Month 2 to Month 6, consumer spending slows, hiring slows, growth weakens. Beyond 6 months, recession risk increases, policy responses intensify. Now consider energy alternatives. High oil prices accelerate change. Electric vehicles become more attractive. Renewable energy gains investment. Countries rethink energy security. This is one long-term effect. Now focus on government response. Governments may release strategic oil reserves. They may cut fuel taxes. They may increase subsidies. But these are temporary solutions. If oil stays high, pressure builds again. Now look at military and geopolitics. Oil at 150 often comes from conflict or disruption. This increases global tension. Countries compete for energy supply. Trade routes become strategic targets. Defense spending increases. This adds another layer of economic pressure. If you want clear, sharp breakdowns of global crises, economics, and power shifts, then subscribe The Financial Story now. You get deep insights that help you understand what's happening before it hits you. Now return to the main question. What changes first when oil hits 150? The answer is simple. Prices change first, then behavior changes, then the economy changes, and finally the global system adjusts. Now think about the US again. Short-term impact? Higher fuel prices, higher inflation, market volatility. Medium-term impact? Slower growth, pressure on households, business slowdown. Long-term impact? Possible recession, policy shifts, energy transition. Now think about the world. Import-heavy countries suffer the most. Exporting countries gain short-term benefits, but global demand falls, so even exporters feel the slowdown. This creates a global cycle. Now focus on one key insight. Oil at $150 per barrel is not just an energy story, it's an economic shock. It affects inflation, growth, employment, markets, and politics, all at once. That's what makes it dangerous. Oil at $150 per barrel is not just a number, it's a signal that the global system is under stress. The first cracks appear in fuel prices, then inflation spreads, then growth slows, and if it lasts long enough, recession follows. The US may absorb the shock better than others, but it cannot escape it, because in today's world, energy connects everything, and when energy breaks, everything feels it. Stay aware, because the next move in oil prices could decide the direction of the global economy, and in a connected world, one blocked route can shake the entire system. The real question is not whether the US will be affected. The real question is how long it can absorb the pressure before something breaks. Stay informed, because this crisis is still unfolding. So for more such information, you can follow us so that we can deliver true, accurate, and trustworthy information to you. Subscribe to The Financial Story now.